Hi, it's Pietro Canestrelli of America's Tax Defender, and today we're going to talk a little bit about income tax reporting for the sale of your personal residence. And with me today is Amy Smith from Tyco Title. Morning, Amy.
Good morning. Thanks for having me.
What does escrow do?
Oh, okay. Well, I've worked at Tycor since 2017, been in the real estate escrow business since 2005. And so escrow and title. So escrow is the neutral third party, right, that handles and moves the money of the transaction. Title, on the title side, we literally usually insure the biggest purchase
Okay.
that a consumer makes, right, a home. And we ensure that the buyer, seller, and lender all have clear title.
So you've been involved with a few real estate transactions, I assume, over the years?
Just a few.
Okay. And have you seen this scenario, Amy? Somebody sells their principal residence, maybe after many years of living there, and then a few months or maybe even a year later, the IRS lets them know that, hey, you didn't report this properly, and you owe us taxes on the full amount of the sale. Have you run into anything like that?
Oh, yeah.
All the time, I assume.
Welcome to the world of real estate.
Yes. Well, it turns out the IRS has turned very aggressive on these transactions. Now, keep in mind, I don't know if it's title or escrow, but one of them are required to file a 1099.
Escrow.
Escrow. All right. So you issue those 1099s, you send them to the IRS, you send them to
The seller.
the seller, and the seller promptly ignores them.
Yes.
Because many sellers of their principal residence, they're unsophisticated taxpayers. They've never done a real estate transaction in their life. They just selling their house. They might be moving into assisted living, something like that. They sell their house. They have no idea, even though they got the 1099 from escrow, that they're supposed to report it, and they're supposed to report it properly. So what happens is they either don't report it at all on their return. They report it incorrectly because they're used to going to H&R Block or somebody that doesn't have the experience in properly filing these returns. And then the IRS makes their adjustment. And unlike most audits where the IRS is going to first contact you by a letter, and then if they don't get response, they're going to knock on your door and introduce themselves. For these type of audits, it's what's called a correspondence audit, meaning the IRS is going to send you 3 letters, and then they're going to send a notice of deficiency. If you don't respond to any of these notices, or especially the notice of deficiency, the assessment goes final. And they tax you on the full amount of the transaction. They don't take away what you paid for title and escrow. They don't take away what you paid your real estate agent. They don't give you any tax basis in the property, and they certainly don't give you the 250,000 or 500,000 exclusion that you're entitled to. So you might have a $200,000, $300,000 tax bill from one of these transactions. Yeah, that is horrible. So please, if you're selling your principal residence and you see this video, contact our office so we could discuss exactly how to report this on the return where you did in the year you did the real estate transaction.